Hi everybody, this is Gary Dean with Sentiment Timing, and this is a little special video update I'm doing since I wasn't able to put anything out all week. Just got over the flu, and boy, I never had it before, and kind of hope I never get it again. That was a tough one. So I've been putting out some little free updates, off of the reports we've been doing and stuff like that, so I can at least keep you in the loop. And I wanted to kind of come full circle, now that I'm feeling a little better and can do a video. So let's get started. At Sentiment Timing, we believe that human beings and the markets are irrational. There's always going to be an irrational element at work, and that's what creates these market opportunities. Now we get these, we figure out where these, irrational elements are at work by looking at Woody Dorsey's proprietary sentiment database, as well as his technical timing indicators, which predict when these markets are going to reverse, and then we combine them with regular technical analysis. So our, the whole newsletter and everything that we do, it's not about being exactly right on these turn dates or anything like that. We're really here to kind of help you make better trading decisions. And even if a turn date doesn't work exactly on the date, does it change the whole kind of landscape of the environment? Does it then make it safe to be shorting? If, for example, we had a turn date on February 8th. It didn't come on the 8th. It made a low on the 8th, and then it started rallying, but we made a secondary low yesterday. So the fact that the 8th wasn't the actual low, did it make it safe to go aggressively short? And it didn't, because we knew we had a technical turn date that was supposed to be to the upside. We had sentiment that was at extreme bearish levels, and as I showed you last night, we had technical indicators on every chart that were given bullish divergences, as well as where it bounced off of support. And right now we have the S&P that's up 26 points. So that's really the whole thing. It's not to sit there and pound the table that we're exactly right. Nobody's going to be 100% right. So again, really the way that we kind of use things is just time, sentiment, and price, and that's how we kind of gauge which way you should be looking in this market. So the market environment that we're looking at right now, long term, we're in a bear market. Woody's been talking about that for really since August, when the S&P was near the highs, that we were going to be entering a bear market. Now that we're some of the indexes are close to 20% down, everybody's jumping into, we're in a bear market, but most of them had missed most of the move down there, so now they're pressing the short side. Intermediate term, we have different time frames. When most people look at intermediate term as 3 to 6 months and stuff, we don't care about that far out. These moves are just too big up and down, that we really just look at it from anywhere from 2 to 3 weeks. It could be 6 weeks. We let Woody determine that with his technical timing indicators. But for the most part, they're from 2 to 3 weeks, could be 6 weeks. So we're expecting a counter trend rally. We've been kind of saying that all the way since January 19th, that there would be a better buying opportunity in this period of time, and that's what we're expecting. And short term, same thing. We're expecting bounces. We don't expect the market to go straight up, because we're in a bear market. But these short covering rallies could be vicious, and that's really what we try to warn you. Don't be married to the short side when things are really not looking like they are going to collapse. So the sentiment, really the way that we look at it, when everybody's euphoric on the market, we want to start eyeing down where the markets are going to reverse lower. When there's capitulation like we saw the past week, you want to start looking on where to buy, as long as we have technical turn dates and everything lining up. So I'm showing you that because I'm going to show you the sentiment, and I showed you this yesterday. And look at all these very, very low sentiment readings. So everybody's bearish on this market right now, and this is not just a trade signal on its own. Woody's mastered this sentiment readings. He's been doing this for over 40 years, so they have to be interpreted. But the big difference here is that notice back in, when we were in this big bull market, every time we got low sentiment, that was what triggered the big rallies. Now, and when we got up here and we had the high sentiment, we would need a bunch of them to be able to roll the market over, as you can see here. But now what's happening is the high sentiment, it's taking only one or two of those to bring it down, and it's taking a series of bearish sentiments to give us a rally. So sentiment is extremely, extremely low. We are anticipating February 8th to be the low. We made a secondary low today, yesterday, and we have technical divergences. So let's take a look at the regular charts here. And I'm sorry, hang on one second. I got another one I want to show you. Here it is. Okay, so the main thing I want to show you, I'd said that we found support. We had bullish divergences on the 60-minute chart, and I'd mentioned that I was counting. The way that I was really looking at things was this was going to be an A, B, C of a B. Well, the fact that we took these lows out eliminates this. But all it does is simply take this and say, okay, here's our A. We're still anticipating this wave B. And that's what we see. That's what I'm thinking is going to be playing out here. So we still have plenty of room to go on the on our momentum before we're in oversold levels. And what I'm showing you here, look how similar they look. If I just kind of expand this up like this, it looks very similar. This move right here. Well, this was the September 30th lows. And if you remember, hang on one second. I'm still getting over this a little bit. And if you remember, we had this big rally, and nobody was really anticipating this rally to extend. Nobody's expecting this rally to move. Everyone's waiting on where should we short next. So does it mean that this is going to play out like this? No, but it's something you want to keep an eye on because, like I said, everybody is short. Everybody that I read and hear on the news right now, it's sell the rips. That's all they want. Well, when everybody's doing the same thing, guess what happens when they start selling or shorting the rips right here? Is when we break through them, we then get a quick move to the next resistance, and when we break through those, that's when you start seeing short covering rallies, and the S&P rally 150, 200 points. So again, I'm not saying this is what's going to happen, but we have so many things that are in line for it that, pushing the short side right now, in my eyes, is very, very dangerous. It's not safe. I'm long. I took a second piece of my long yesterday near the lows. My stop's at entry, and I'm just going to let things ride out right now. If I'm right, then it's going to be a real nice trade. And this is just me. This has nothing to do with sentiment timing. We don't put out trade alerts. But what I do is, anybody that does subscribe, I give them a free membership to MarketsPath, and that's my other website that I do, and that's where I do the trades and these nightly videos. But this is really how everything works. It's as long as you know how everybody is feeling about the current environment and where things are. And if you have a technical turn date that was supposed to be coming on the 8th, and we're looking for the rallies to go up, and from there we have bullish divergences as well as support, as well as a fractal pattern, I'd rather be going long than short right now. And my thing is this: even if they decide that this is not the move and they got to come back down, I'll simply just look to buy again, because this A is just going to get moved over to here, and we're still, the pattern hasn't changed. We're still anticipating this next move. Now, the biggest danger about, being short right now is everybody that I read just to get a good sentiment as far as what the newsletters are doing, and everybody has the same feeling is, stay short, keep shorting until the S&P gets to 1750, then cover shorts and wait for a big counter trend rally, which is going to be the wave 2 or the B. Well, guess what? When everybody's waiting here and they're not worried about this, they're going to end up covering all the way up here, most likely with losses after having very big gains. And in this market, you can't, when you have decent profits, just take them and go. So it's, it's just one of those things. Whether you're bullish or bearish, I mean, the bulls did this on the upside. they, you know, are waiting for 2150 before a big pullback. And most of them are still long because they're, you know, they're just trapped right now. And the same thing with the bears. You know, when you have decent profits, take them. So anyway, I'm leaving the same the same promo code if you guys want to join up. It's $74.99 for the first month. Just use the coupon code. And with that, have a great weekend, a great Valentine's Day, and I'll talk to you guys next week.